It's the FDIC's shocking warning. I'll show you why your money may not be safe. Plus, based on the latest data we just got on the U.S. consumer and the manufacturing sector, it indicates we may be far closer to the next banking crisis than most people believe. This is one show you don't want to miss. Now, let's turn to Bloomberg, where we picked today's story with the headline, as paper losses shrink at U.S. lenders, according to the FDIC's latest update. And what the FDIC wants you to believe is that things are getting better for the banks. But what they don't want you to know is they're still sitting on massive losses. And this goes all the way back to the pandemic, when interest rates crashed and the government issued massive amounts of debt. What we found out is a lot of the banks bought this debt up, and then what happened after that? The Federal Reserve jacked interest rates up. They put the banks in a precarious situation. They're massively upside down, not just on all this debt, but on their loan portfolio as well. When we face the next crisis, the problem is the banks aren't going to liquidate assets because they don't have a means to. If they start to sell, it means they're going under, and in a major way. The problem is we're much closer to the next banking crisis than most people believe. And the unrealized losses on held to maturity and available for sale securities shrank 4.3% to just under $400 billion. Now, what is a hold to maturity security? It means the bank buys a security, it puts it in a special allocation that says, look, we're not planning on selling this, we're not going to sell it. And this means they don't have to allocate the losses on their books in the same fashion as they do for available for sale securities. Just because they're available for sale, it doesn't mean they're actually selling, it just means they can. But let's take a look at this chart, because the FDIC wants you to think, well, things are getting better. But the problem is they're not getting much better. And the reason is very simple. Let's go back to pre-pandemic. What happened is banks would normally buy bonds at a sub 5-year maturity. During the pandemic, they were buying 7 to 10 year maturity bonds just to get yield. And now the problem is they're stuck on bank balance sheets. And of course, a lot of people think, Steve, the Fed's never going back to zero. They say this all the time, and yet the evidence is clear. You want to fix these unrealized losses, you can better believe the Fed is going to be back at zero during the next crisis. The banking industry continued to have strong capital and liquidity levels, which support lending to protect against potential losses. This according to Travis Hill, the agency's acting chairman. He says at the same time, institutions continue to navigate weakness in certain loan portfolios and elevated unrealized losses, among other challenges. So he's trying to tell you that, look, everything's A-okay, but what is the issue with these loan portfolios? Well, the problem is it's the delinquency rate. It's continuing to rise. What we're seeing is the economy slowly running out of money, and when that happens, the delinquency rate starts to increase. It means banks have to set aside more capital. On top of that is they still have these large unrealized losses. They can't sell these securities to raise cash. And so if we see another banking crisis and consumers respond just as we've seen in the past, where they start withdrawing their money, we could see a large number of banks once again have massive insolvency issues and potentially fail. And this is what the FDIC is trying to quietly warn you about, is look, there's real risk in our system, but we don't want you to know exactly how bad it is. And the tally of problem banks now is getting extra scrutiny from regulators. That fell to 59 at mid-year from 63 at the end of the first quarter. So despite the fact that the economy's turned around, what we're still seeing is there's about 60 bad banks out there. And again, this poses a huge risk to depositors, because again, the normal move for banks is to sell these securities to raise cash when financial conditions tighten up and depositors start to demand their money. They're in a position they can't do that. So the issue is, you think about this from the Fed's perspective. Why doesn't Fed Chair Powell want to lower rates? It has everything to do with these unrealized losses. He wants the banks to lend as much as they can at current rates. He wants, as these portfolio of bonds roll off their balance sheet, he wants them to reinvest into the highest yield he can get them, because he already knows he's going back to zero. He just doesn't want to see a bunch of banks fail under his watch. And the evidence is clear as we take a look at the commercial industrial lending data that's shown in blue against the federal funds rate in red. And what I want you to see is the Fed's normal policy is to respond when lending starts to slow down. And so you see when the blue line falls, well, the Fed starts to cut rates. When it contracts, well, that's usually a warning sign. It means we're already deep into a recession. And of course, what does the Fed do? They continue to slash rates. But where are we at now? Well, we're seeing commercial industrial lending rise. Of course, we know this is largely supported by front running of the tariffs. But if you understand from the Fed's perspective, they really don't want to cut rates here. Now, I know a couple members have come out and said, look, we support a rate cut. But if you think about it from the health of the banks, what does the Fed really need them to do is get high yielding assets. That means they want them to lend. They want them to lend at prevailing rates. They want them, as their bond portfolio rolls over, to buy new higher yielding government debt, because the Fed knows when they start to cut rates, the banks are going to need to sell off some of these assets to raise cash, because the Fed doesn't have the ability to run in and rescue them. And that is the problem we're facing right now, which is why the FDIC is warning that your deposits may not be safe. But if you think the next banking crisis isn't likely to happen, based on the latest data we just got from the U.S. consumer and the manufacturing sector, as you're about to see, it indicates it could be here far sooner than most people believe. As U.S. consumer confidence falls slightly on job and income concerns, and one thing that shouldn't be falling right now is your confidence on your trading account, because I get really excited when my subscribers make money, and right now they're making a ton of money on GDX. Let's check out this trade we told them to put back on the 21st. It's now up 3.59% and continuing to go higher. Now, this was from our new Metre strategy, and this is included in any of our subscriptions right now at no additional charge. We're going to have more information on this at the end of the show, but if you want to start getting trades like this, grab those links in the description below. Use a coupon code for your free 30-day trial, because consumer confidence is changing, but right now it continues to hover well below levels seen prior to the pandemic. So as we look at the health of the consumer, what we're seeing is they're less confident than when we were going into the pandemic. And why does that matter, my friends? Because we were headed into a recession before the pandemic hits. And that's what consumers are saying right now. The recent labor market slowdown is added to economic concerns stemming from President Donald Trump's tariffs. Job growth and wage gains have significantly slowed. This is something we've been talking about, and it's become increasingly difficult for unemployed Americans to find a new role. So as demand for labor falls, this means employers don't have to give out big pay raises. As demand goes down, they also cut hours. And what we're seeing now in these surveys is consumers are echoing everything that we've been warning is going to happen. And when you start to put this in the perspective of the banks, well, let's take a look at incomes first, because as incomes go down, well, it puts stress on the financial system as the delinquency rate heads higher. Let's take a look at total incomes of production and non-supervisory employees. This in blue is a delinquency rate of credit cards in red. And what you can see is incomes go down. People cannot afford to pay on all their bills. That means they enter delinquency, and you can see very clearly the delinquency rate tends to rise. Now, this doesn't happen every time, but you can see it happens most of the time you see incomes drop. And since 2021, what have we seen? Incomes have been on a downslope, and at the same time, we've seen the delinquency rate rise. And while the experts are saying, look, the delinquency rate is settling down here, the risk we're facing, we're going to find out more about this next Friday, is hours worked are likely to continue to get cut as we see the economy slow, and employers, as they're unable to pass on higher costs to consumers, are going to have to cut back on pay raises. And all this means is the income, the total income for many Americans, is going to continue to slide. It means we're likely to see the delinquency rate rise. And for banks, this is setting up for the next big banking crisis. And the evidence that the labor market is likely going to weaken, which we'll get evidence for next Friday when we get the next non-farm payroll report. Let's take a look at the Conference Board Consumer Confidence Labor Differential. And this is the share of consumers that have said jobs were hard to get. It rose for the second month to the highest since 2021. The share saying jobs were plentiful was a little change. And the difference between these two, a metric closely followed by economists to gauge the job market, fell slightly, continuing to decline over the last 3 years, as you can see here. But look what happens in the past. When we see this, what does it mean? We're headed right into a recession. Of course, we know what happens during recessions. People lose their job, they stop paying on the bills, and next thing we know, the Fed is back at zero and the banks are facing an all-out crisis. So it starts to make sense now why Powell doesn't want to cut rates. And once you understand it from the perspective of the banking system, and remember, he didn't have an answer for the last crisis. You know, when those small and mid-sized banks saw that liquidity drop and we saw the bank runs hit, the Fed didn't see it coming and they didn't even have an answer for it. In fact, later on, the Fed admitted, we're not even sure what we did to fix it. But nevertheless, they did offer banks a way to swap some of their debt for cash. The problem is, again, Congress said it can't do that anymore. Deterioration in the labor market has become a focal point for Federal Reserve officials as they determine when to resume cutting rates. And that's why we're likely to see focus on that next non-farm payroll report. Again, that's coming next Friday, and believe me, it's going to be a big one. The world's going to be watching, because if the unemployment rate starts to go up, well, what it means historically is the Fed is going to cut. And the problem is the Fed cuts into rising unemployment. It means we're headed right into a recession. Now, so far, that half a point cut the Fed did, at least from the Fed's perspective, they could say, look, the unemployment rate's flat. We're seeing lending accelerate here. There are no major red flags, maybe some yellow flags in this case, but nothing that says, look, we need to urgently cut rates. Because at this stage, if the Fed were to start cutting again, it means we're going right into recession in the Fed. And when you see this banking data, when you realize all those unrealized losses on bank balance sheets, it's very clear why we're going back to zero and why QE is going to be back in a major way. Among demographic groups, confidence fell for consumers under 35-year-old, was stable for consumers 35 to 55, and rose for consumers over 55. Now, why did it rise for those over 55? Because most of their wealth is held in the stock market. But what about those younger workers? Well, they're facing a labor market. They're facing an economy that isn't working for them. And as things slow down, they're the ones at risk of losing their job, because employers have clearly said, and said repeatedly since the pandemic, right now they value their experienced employees. That means those new hires, those young workers, they're the ones that are likely to lose their job. And that's why we're seeing confidence among younger workers decline. Of course, we know when confidence goes down, spending falls, because as people worry about their job, well, they start prioritizing saving money, paying off debt, and they don't go out and spend. And all that does is have an impact on the lending markets, because we know U.S. consumers love to borrow money they don't have to buy things they don't need. But when their confidence goes down, they don't do that. And here you can see the relationship between the commercial industrial lending data and the University of Michigan Consumer Sentiment Survey, where we always tend to see them either go down together, or we see confidence fall and then we see lending come down after it. Now, the issue we're facing as of 2024, what happened? We saw confidence come plunging down, and it's recovered a little bit, but not much. And what does that tell us about the lending data here? Well, we know it has everything to do with front running the pandemic. And if this relationship between consumer confidence and bank lending is in the indicator, we're likely to see the lending data come crashing down. That would mean the labor market's coming unwound. It would also mean we're going to see the Fed cutting aggressively here. So the risks are high as we look forward and see, is there a potential for another banking crisis? You can see very clearly, based on the confidence data, it's absolutely now in the cards. Now, you may remember I said this would spill over into other parts of the economy. Let's take a look at the housing market, and then I'm going to show you the relationship between the lending data and the manufacturing sector, which is, again, flagging another warning. We could be on a cusp of an all-out crisis. As home prices in the U.S. increased at the slowest rate since 2023, and that's on a year-over-year rate of change, because the national gauge of prices rose 1.9% from a year earlier, but that was the smallest gain since December of 2023 and followed a 2.3% increase in May. Now, you can see this blue line's clearly decelerating, but the problem is you have 4 months in a row of month-over-month declines. That means people that are selling their home are cutting their price. And remember, we talked about builders who are slashing their price. This was going to backfeed into the resale market. You're seeing it happen now. There are people out there that need to sell their homes. You may be one of them, and you're facing a market that doesn't have a lot of buyers, interest rates are high and the economy is slowing. When this happens, people are forced to cut their price as much as they can just to sell. Now, the problem is for a lot of people that bought during the pandemic, well, they don't have the margins the builders have. And again, this is how things get upside down fast and why people walk away from debts. Of course, we saw this during the financial crisis, so you could see the risks for the banks here are increasing. But let's turn to the manufacturing sector as core durable goods orders, again, that's excluding food and energy, rise at the fastest annual rate in 3 years. Now, when you start to add back in the transport sector, well, you get a minus 2.8% month over month. That's a big thanks to Boeing. And of course, this is a problem because, again, they reported fewer factory orders. Now, this is going to be a major problem because as the economy slows and consumers spend less, you see inventories build up, which is a problem we have exactly right now. And as inventories build up and they can't get moved, that means new orders at the factory level decline. Now, what a lot of people don't understand about the lending markets is that all these factories, they don't have piles of cash around to finance their own orders. They go to the banks to get money. So as you see new orders go down, well, what you should see is a contraction in commercial industrial lending. And that's exactly what this chart shows here as we now overlay manufacturers of new orders of durable goods in red against the commercial industrial lending data. And what do you see where new orders go? Well, the lending data follows. And right now we're seeing a huge reversal in new orders. Of course, we can see the relationship of why the bank lending increased, but as consumers get less confident and they start spending less, you're going to see a big collapse in new orders. And next thing you know, the lending data is going to collapse right alongside interest rates. And as we turn to the Richmond Fed, there's very evidence here that one part of the country is experiencing that slowdown. The 5th District manufacturing activity remained soft in August, according to the Federal Reserve Bank of Richmond. The composite manufacturing index rose to -7 in August from -20 in July, meaning it contracted at a slower rate. So it's still contracting, just not as bad. Shipments increased to -5 from -18. New orders rose to -6 from -25. And employment increased to -11 from -16, meaning shipments got a little bit better, but they're still slow. New orders continue to contract at a slower pace, and companies continue to lay people off. And a lot of this has to do with the fact that they're absorbing a lot of these price increases. And when that happens and demand goes down, as I said, they'd be forced to lay off. And it's exactly what we're seeing. The average growth rate of prices paid increased notably, while the growth in prices received was nearly unchanged in August, validating that manufacturers in the Richmond Fed District are absolutely absorbing all of these price increases because they realize they can't pass it on. Now, for workers, what did we just see in the data? What did they see in the confidence report? Is they're not seeing wage gains. Well, if employers are absorbing price increases, they can't give out more wage gains, and as demand goes down, hours get cut, jobs get lost. Now, firms expected a growth in prices paid to remain elevated and expected growth in prices received to increase over the next 12 months, meaning they're hoping to pass this on to consumers, but the reality is the U.S. consumer cannot afford that at all. So now you can see why the FDIC is warning consumers their deposits may not be safe, because based on what we're seeing from the latest data from consumers in the confidence survey and from the manufacturing sector, it says we're about to see a huge collapse in lending. That means we're on the cusp of another financial crisis. And based on the large unrealized losses still sitting on bank balance sheet, they've got absolutely no way to respond, particularly if we see a massive bank run. It means we could be facing massive insolvency. We could face bank failures, and now you know why the FDIC is warning. But just because the FDIC is saying your money may not be safe, it doesn't mean your trading account may not be. Let's take a look at our reports here. We've got two reports. I want to show you that meta strategy. Now, one of our reports is called CTA Time Pro, and we trade against the machines. And why do we do that? Because machines trade hundreds of billions of dollars. And what we do is we look at a historical overlay to see how they're positioned, when meanwhile, their actual look back is somewhere between, say, 3, 6, maybe 12 months. So based on history, we look to see when they're off size and they need to be big buyers, and that signals on a report, and that goes right out to our subscribers. Now, maybe you like to trade those technical indicators like the RSI and the MACD, but you find yourself getting in late and out early and all over the place. Well, we take all of those indicators, we aggregate them together, we pair it with the trend. We call that Momentum Timer Pro, and we give you momentum indicators on a 1 day, 1 month, 3 month, and 6 month basis. And just like all of our reports, we're fully back tested, so we know when we face a high probability trade, it goes right out on our hot list. But in addition to that, we've recently put together a Metre strategy, and this is an advanced trading system that combines 9 professional trading strategies into a single intelligent signal generator. It provides 31 times more frequent buy signals than individual strategies while maintaining high quality through multi-strategy consensus. Now, it's optimized for swing trading. It's got a target hold period of 2 to 15 days, generates over 155 signals per year, and has a success rate of 55% with fast profit taking, meaning we did fully backtest it, we did fully validate it. Right now, it's included at either of our ports at no additional charge. So you get the daily reports, you get the tradable signals, you get my opinions on the best trades. We give you risk control levels, a full tracking of all our open trades and returns, a weekly update, and here's the best part, you don't have to put a dime out. You want to compare us to your existing strategies? By all means do it. It will cost you nothing for your first 30 days. All you have to do is grab those links in the description below, use a coupon code for your free 30-day trial. And with that, I'm Steve Van Beener. Thanks for watching. Thanks for being fans. Bye now.